In this video, I'm going to teach you about the S Corporation payroll tax strategy. You'll understand why most small to mid-sized businesses are set up as S corporations and what the tax goal is that we're trying to achieve. It's important that you as a business owner understand the purpose of using S corporations and how to best optimize that strategy to make sure you're saving as much tax as possible. There may be situations where an S corporation is not preferred, and so I'll talk a little bit about those. A lot of CPAs make the mistake of just assuming you should have an S corporation, but there are some businesses in certain jurisdictions where S corporations might actually be a worse tax result at the end of the day. So it's important that you as the owner understand when the S Corp is the best strategy for you and how to use it in the best way possible. So just to start, the main benefit and the sole reason we usually use S corporations is to reduce what we call payroll taxes. So payroll taxes are taxes that a lot of people don't even know they're paying because they don't necessarily show up on your tax return, at least not in an obvious way where you can see how much you're paying. Most people pay payroll tax where they get a W-2. You might be an employee of a company, and unless you look at your W-2 in detail, which is probably unlikely, you may have no clue how much payroll tax you're actually paying and how much is just being automatically withheld from your W-2 salaries that you receive. If you're a business owner, that payroll tax may show up in your W-2, but depending on your structure, it may also just show up on your tax return in a way that you would never notice it. We often call these payroll taxes for small business owners self-employment taxes. Those are basically the same thing here. We're talking about the different taxes that you have to pay on any wages or salary income that you receive. Payroll taxes or self-employment taxes are the reason why salary income is the worst type of income you can get from a tax standpoint. There is virtually no other income out there that is taxed at a higher effective rate than what you receive as a salary. When I say salary, I'm talking about that amount that shows up on your W-2. And I'm also talking about if you're a single owned business where you're the sole owner, but you may be operating through an LLC, but you haven't made any tax elections such as the S Corp election, then your salary is 100% of the business profits that your business makes. So you can imagine this is a very bad tax result, and this is why we use the S corporation. There are limited other situations where S Corps might be beneficial, such as for SaaS companies, and I talk a little bit about that in some of my other videos. But for our purposes of this video, it's important to understand that the S corporation is really just a payroll tax reduction strategy. So let's start by looking at just how bad the payroll tax consequences can be if you don't use an S corporation. So this is just a basic example, and here I'm going to assume that we have one owner of a business, and that business has not made an election to be an S corporation. You might have set up your business through an LLC, but for tax purposes, LLCs are useless. They are solely an asset protection legal concept. So just from setting up an LLC, it doesn't save you any taxes. Anyone who thinks that's misunderstanding the way we use LLCs. LLCs are vehicles for asset protection, and that's it. There's nothing more than that. But to make an S corporation election or to make some, other tax elections that we're not going to cover in this video, you need an LLC. You need an entity. There are certain other types of entities that you can make S corporation elections. Certain incorporated or corps can be set up and make an S corp election. But for our purposes, I would set up an LLC. I don't understand why people sometimes set up Incs or corporations to make the tax election. If you want to be an S Corp, set up an LLC, and that LLC can make that election to be an S Corp. So it's important at the start to understand an S Corp is a tax election. So it is an election that you file with the IRS for your LLC, your business's LLC, and you tell the IRS, I want to be taxed as an S corporation. An S corporation is taxed the same way as any other flow-through entity. The business itself will file an S corporation tax return, but that entity will not pay any tax itself other than, there might be some state filing fees, but an S corporation is not subject to federal income tax. It simply reports the income and expenses that the business earns throughout the year, and then you'll get what's called a K-1 as the owner, and that K-1 will be reported on your personal tax return. So there is no double tax like you have with a C corporation, and there's no situation where your S corporation for federal tax purposes is paying a tax. It is simply a flow through, meaning that any income or expenses of that S corporation flow through currently to your return. So you're not getting any kind of deferral in tax by having an S corporation. Again, everything is going to be reported on a current basis, but the benefit, and I'm going to show you how that benefit works, is that you're going to reduce payroll taxes. So what are payroll taxes? So we pay a number of payroll taxes we don't even know we're paying. For example, we pay Social Security tax, and there's two layers of the payroll taxes. So I'm going to talk about Social Security, Medicare, and additional Medicare tax. But essentially, there's two different ways these taxes are imposed. They're imposed on you as the employee, so to speak, even if you're the business owner, you're an employee in this case. Or the other side of it is imposed on the company. So here, you as the employee or owner pay one half of the tax, and your S corporation or your company pays the other half. So this example only talks about your half as the employee, and that's because your business, you do get a deduction against your business income for the company's share, their half of payroll taxes. So while that's not a perfect tax savings because it is just a deduction against income, it's not actually a reduction in the tax you pay as a credit. I'm going to ignore the company's half, but keep in mind that these tax savings I talk about are actually even higher than I'm showing because of that. So what are the taxes that we pay on our payroll? So Social Security, you pay 6.2% tax on up to the first $147,000 of income. So that's a huge number. So if you make over $147,000, you don't have to pay any Social Security tax above that. But all of us pay 6.2% on that first $147,000 that we pay. And that 6.2 is our share of the Social Security tax. Keep in mind the company pays another 6.2 as well on your wages or income. Then there's a Medicare tax. So the Medicare tax doesn't have a cap on it. That actually goes all the way up. So if you make $1 million, you're paying that Medicare tax, and it's 1.45% is your share of that. And you're paying that on whatever you make. So there's no cap on that. And so if you make a lot of money in your business and you don't make this S corporation election, your Medicare tax could really get out of control pretty quickly. There's also an additional Medicare tax that applies now, and that is 0.9% on any wages or income above $200,000. So again, if you're making over $200,000 in salary, or your business is making more than that, then that additional Medicare tax is almost a percentage point on anything above $200,000. So that can also, depend on how much money your business is making, can be quite large. So I'm using a very basic example here. A lot of businesses, keep in mind that as you make more and more money, these numbers are going to get more and more out of control and higher, and the tax savings is going to get bigger. So on the left side here, this is an example of the situation if your company just doesn't have an S corporation election. In fact, you're a single owner and you didn't make an S corporation election because you didn't know about it. So what happens is you say your business's net income is $350,000. Without the S corp election, and again, we're talking about federal tax consequences here. I'm not talking about state, but without the S corp election, you're viewed as having made $350,000 of salary income, basically, because you're going to pay payroll tax on all of that income. So what that might look like is when you add in and again, this is your share. This doesn't take into account the company share. So really it's double this because the company is going to pay their share of $15,539, but there's a deduction on the tax return for that. So there is some offset there. But your share and what's just going to come out of that money and go straight to the IRS when you file your tax return, or if you get a W-2, which you probably wouldn't if you don't have an S corp, but you're going to pay $15,539 in payroll tax. So again, That's a lot of money, and that gets missed a lot. And I'm only talking about a business that makes $350,000. When your business grows and it's making over $1 million plus a year, that number is going to get significantly higher. And these are just easy tax savings that we could have if only we knew about the S Corporation election and made it. So let's say the right side here, this business owner watched my video, made the S Corp election, and understands how to use this strategy. So when you make the S Corp election, you're now a business and you've got to decide between what's going to be W-2 salary income and what's just net income of the company itself. So you're required to pay yourself a salary. You can't just say, I want 0 salary and 100% to be net income. In most cases, if you're completely passive from the business, you could do that. But if you are passive, you're not paying payroll tax anyway. So I'm assuming you're involved in the business in some respect, but your salary has to be reflective of that. So if I, do everything for the business and I work, 100 hours a week, then your salary's got to be quite high. And maybe it needs to be almost $350,000 in that case, but you've got to have a salary that reflects what you're doing for the business. So most of us are business owners and we're not doing the day-to-day, we're not doing the minutia. We're kind of more of the strategy and we're acting more as a visionary for the company. So we don't have to pay ourselves a ton of money, assuming that that's our fact pattern. And what you want to do with this strategy is really important you understand this. You want this amount to be as low as possible. So as low as you can reasonably justify from a tax standpoint. You want this number as low as possible, and you want this number as high as possible. So when you're splitting the pie of $350,000, you want to paint a picture and have your facts, and you might need to change what you do for the company. It might save you a lot in taxes if you do that, but you want to justify as low an owner salary as you can get. When you do set up the S Corp, you are going to have to run payroll. So even if you're the only employee, if you set up the S Corp structure, you now are getting a salary. So you need a W-2, you need to run payroll on that. You can use Gusto or, any other resource on that of how to do that. But you've got to act as if you're an employee and you're getting, a W-2 from the company. You don't have to run payroll in the first scenario if you're just an LLC and single owner. And that's because that money is just all going to flow to your tax return and be subject to self-employment tax. But with an S Corp structure, and that's the one headache I think of having an S Corp, is in addition to having to file an additional tax return, is that you do have to run payroll. So keep that in mind. You need to set up a Gusto or JustWorks account or something where you're paying yourself and making payroll tax filings for your own salary. You need to figure out what you're paying yourself. Again, want to try to have a situation where that's as low as possible. So in my fact pattern, I'm saying, this owner's somewhat involved, but they're not like super involved in the day-to-day and they don't have to spend a ton of work hours each week on this business. So let's say they pay themselves $75,000. So that's the owner's salary that we're going to set. The other amount of the $350 net income of the business, that's going to be just S Corporation net income. So that's $275,000 when we take out our $75,000 salary. So that $275,000 is just considered net income of the S Corporation. It's considered, just net business income after you take into account the owner's salary. You can still take that money out. So you're able to still take out $350,000 from the business. It's just $75,000 is coming to you as W-2 earnings, and the other $275,000 you can take as a distribution, or it's also commonly called an owner draw from the S Corp. But you can still get that money out of the business. This is just kind of delineating how we're taxing it and how we're bucketing for tax purposes. So here you can easily see the payroll tax goes down because the payroll taxes are only being applied on the $75,000. They're not being applied on the $275,000. So at the end of the day, you're only paying payroll tax of $5,700 in this fact pattern. And here you can see the difference between the two is that in example one, I'm paying $10,000 more in payroll taxes every year than I need to be if I just simply made the S Corp election. So again, keep in mind, I'm only talking about a business that makes $350,000 net income. If your business makes more than that, or you're going to make more than that in the future, then that savings is going to go up significantly. So again, with the S Corp, just keep in mind that you are going to have to make a filing. You're going to have to file a separate tax return called an 1120S. And that tax return is due earlier than your personal return. So those are usually due March 15th now. So you have to file that return. You have to report those items on that return, and then you'll get what's called a K1. And then that K1 will be input into your personal return. So you might have to pay your CPA a little bit more to do the taxes every year, but it shouldn't be that big of a deal because they're reporting the same amount. It's just filing additional form than they had to file before. The other thing is that you have to, as I said before, you have to run payroll. So set up an account with some, use a cheap payroll service because it's just you or just probably you and a few other employees. So make sure you set that up. You're going to have to do the W-2 filings and the state payroll tax filings and federal payroll tax filings. But the software should do that for you. Don't waste your time on it. It's a headache, but just go ahead and pay the software to do that for you. Lastly is that I mentioned this before, you have to affirmatively elect to be an S corporation. So how do you do that? You do that by filing a form with the IRS. And this is the form that you have to file. It's called a Form 2553, Election by a Small Business Corporation. I'll link to that in the comments below so you can access the IRS's form of this form that you can file. So this is the form. You have to fill this out. It's several pages, send it to the IRS. And essentially, if you have a CPA, you could use them to file this for you, but it's something you could do yourself. Just read the instructions to the form and do it right. When should you file this election? So ideally, best case scenario, you should set up your S corporation, when you start your business, if you want to have the most tax savings. But keep in mind, if your business isn't making money, then you don't need an S Corp, right? Because you're not paying payroll tax if you're not making any money. So you don't really need an S corporation, and you don't need the headache of having to file the separate tax return until your business is profitable. There's a rule of thumb out there. Some people say wait till you're making $100,000 a year. I disagree. I think once your business is profitable, like maybe making $30,000 net income a year, then that makes sense to start having the S Corp and go ahead and get that structure in place. If you are the one caveat is if you are a SaaS company, I would put the S Corp and structure in place from day one. And that's got to do with some other tax planning when you go to sell the company or the software in the future. So, check out my resources on tax strategies and planning for SaaS business owners. But other than that, if you're just a typical non-SaaS company business and you're not dealing with software that your business is creating or developing or, working on, then, you could wait till you're starting to make money. You don't really need to pay yourself, a salary when your business isn't making money. So if you have the S Corp in place, it's really not going to save you any money in the first few years if your business is not net positive on a tax standpoint. But I wouldn't listen. I don't know why people say $100,000 is just kind of pulled out of the thin air. I would do it, once you're making 30, 40, 50 grand net income, you can start to see the savings here, and you can go ahead and get in the habit of having the structure in place. There's another thought that, and I've seen this in practice, that you're less likely to get audited if your business has an S corporation. I think there's some truth to that because a lot of, that we've seen in practice that the IRS agents often audit single owned companies that have just an LLC. So in that case, you're filing what's called a Schedule C to your 1040 personal tax return. We do see those get audited at more higher frequency. And that, I think is because if the IRS sees that you have an S corporation in place, then they know they're dealing with a sophisticated taxpayer. They know you're probably either seeking tax planning advice or you're working with a competent, tax planner, or you yourself know what you're doing because you're educating yourself, like watching these videos. So that is a thought out there, is that, based on our experience, you could be less likely to get audited if you have an S Corp in place. Again, I wouldn't let that drive me setting up an S Corp when I just started my business and it's losing money, just because I don't think, that it's worth that. But just keep in mind that there is a lot of thinking out there that having an S Corp in place can reduce your likelihood of getting audited. I do want to talk about a limited situation where an S Corp might not be beneficial, and that is for businesses that operate in New York City or Washington, D.C. So the reason is that New York City, I'll use that as an example because that's where I'm based, but the same applies for Washington, D.C. New York City does not recognize the S Corp treatment. So what happens is they're going to treat you as if you're a corporation, a C corporation, and they're going to impose a corporate tax on you. So the way this works out in practice is that in a lot of cases, the additional New York City corporate tax that you would have to pay by being an S Corp commonly and usually outweighs the payroll tax savings. So in that case, if you are in New York City or Washington, D.C., it might be better to just have your LLC and not make the S Corp election. I can tell you, I don't have the S Corp election for some of my businesses that are based in New York City because that's where I am. Because when I model it, it's not a net tax savings to me. So this gets missed a lot. I see this missed all the time. Donald Trump's tax returns were just recently released, and people were saying, why did he not have S Corp elections for some of his New York City companies? And that's because they're based in New York City, and that's why he didn't. So I've seen a lot of CPAs be critical of the tax planning that was done for him on that, but that is wrong. They don't understand New York City laws and how they work. And I can tell you most big businesses that are based in New York City do not have an S Corp election in place. And that is because usually you might see that the tax that you have to pay to New York City, which is a lot, unfortunately outweighs the payroll tax savings. So keep that in mind if you're in New York City or if you're in Washington, D.C. The other nuance is that if you're in Louisiana and you've got, multiple business owners and one of those is not a resident of Louisiana, so let's say you've got two business owners that own a business and one's based in Louisiana and the other's in California, for example, you might want to work with someone on that because it's not always beneficial to make the S Corp election because the non-resident owner of Louisiana might get hit with some additional taxes that might outweigh the benefits that you're saving. So keep in mind, it's not always just 100% slam dunk that an S Corp makes sense for you. And so, make sure you understand, educate yourself on this stuff, particularly if you're in New York City or Washington, D.C. The other thing is that occasionally you're required to also, this form is for federal purposes, but in some states like New York and New Jersey, you are required to actually file a state level S Corp. So let's say you're in New York, but you're not in New York City. So you decide an S Corp's the right option. Then you still have to file with the state for them to respect that treatment. So make sure you check if there's any state filings. I know if you're in New York or New Jersey, those are required. And there could be some other funky filings that are needed in some states, but just make sure that you get everything filed that you need to. It's not a difficult election to make, but you want to make the election, when you want to make it soon in the year, it would be due before, March 15th. If you're a calendar year taxpayer and you want to make the election for, let's say, this year and be an S Corp for this year, you would need to file it before March 15th. So you don't have a ton of time to get that election in. In some cases, if you're late, you can file for what's called late election relief. And that's not that hard. You probably need to work with a CPA to do that. I've never seen those not get approved in practice, but there's just an extra hurdle that you have to pass when you're filling out the form if you're doing late election. But try to get those S Corp elections in on time. So again, this is just an easy payroll tax planning strategy for the most part. But it's important that you understand what you're trying to do. If you're going to set up the S Corp and then just not, and then pay yourself a huge salary that doesn't make sense, you're defeating the purpose of the planning. So you as the owner need to understand what we're trying to accomplish here, figure out what makes sense. You're in the best position to decide what salary you should be paid as the owner. And, if you need to change your facts a little bit, change them so that you can pay yourself and justify a lower salary. But you need to understand what we're trying to accomplish. We're trying to get your salary as low as possible and save on those pesky little payroll taxes. So hopefully you found this video helpful. If you did, please like and subscribe to our channel.